The Minority Market. Episode 17. How to Evaluate a Company Without Numbers. Most beginners believe that analyzing a company requires spreadsheets, ratios, balance sheets, and financial statements. They assume that understanding numbers is the only way to determine whether a stock is worth investing in. While numbers are important, there is a deeper layer that often gets ignored: evaluating a company qualitatively. Thinking like the minority requires understanding the business without being enslaved to the complexity of financial reports. This is the foundation of long-term, resilient investing. The first step is to understand the purpose of the business. What problem does it solve? Who are its customers? And why do they choose this company over others? Understanding the core value proposition provides insight into whether the business has sustainable demand. A company with a compelling solution to an essential problem is more likely to survive and grow than one chasing trends or hype. Beginners, however, often confuse hype with strength, assuming popularity equals profitability. This is the first trap. Next, consider the durability of the business model. Does the company have recurring revenue? Can it survive economic cycles? Are there natural advantages that competitors cannot easily replicate? This is the essence of competitive advantage. Some companies rely on temporary trends, fads, or government incentives. Others have established brands, customer loyalty, or unique technology that make them resilient. By observing the business contextually, without immediate reference to numbers, you can often predict which companies will thrive in the long run. Management quality is another critical qualitative factor. Leadership sets the tone for strategy, culture, and operational discipline. Observe how the leaders communicate with stakeholders, treat employees, and make decisions under pressure. Do they prioritize long-term value or short-term appearances? Are they transparent about challenges or only highlight successes? Beginners often overlook management because it is not quantifiable, but leadership mistakes can destroy companies faster than market downturns ever could. Another element is market positioning. How does the company fit into its industry ecosystem? Is it a leader, a challenger, or a niche player? Market positioning influences pricing power, margins, and resilience during competition. Companies with strong positioning can navigate challenges, adjust to change, and maintain profitability. Observing competitors, customer perception, and market share helps you understand positioning without needing financial spreadsheets. The customer experience is a qualitative indicator often ignored. Happy, loyal customers are a sign of durable business. Look for signs of satisfaction: reviews, repeat purchases, word-of-mouth growth, and brand perception. Conversely, complaints, declining engagement, or negative sentiment indicate structural weaknesses. Numbers may tell one story, but customer behavior often tells the truth more clearly. Culture and values also matter. A company that aligns its operations with strong principles and long-term thinking is more likely to succeed sustainably. Toxic culture or misaligned incentives create operational inefficiencies and moral hazards. While culture cannot be quantified easily, patterns of hiring, retention, communication, and ethical behavior reveal much about potential longevity. Product or service quality is critical. Examine whether the company consistently delivers value. Does it innovate? Does it maintain quality while scaling? Many beginners chase growth statistics without checking whether the underlying offering remains strong. When quality erodes, growth eventually collapses. Observing product or service quality provides early signals of sustainability. Another overlooked factor is adaptability. Markets change constantly. A company's ability to pivot, innovate, and respond to external pressures determine survival. Qualitative observation of past actions during crises, technological disruption, or regulatory shifts reveals adaptability. Companies that fail to evolve eventually lose relevance, even if historical numbers look impressive. Brand strength is also a reflection of qualitative advantage. Strong brands generate loyalty, command pricing power, and create barriers to entry for competitors. Evaluate how recognizable and trusted the brand is, how it communicates with the public, and how it maintains reputation. Brand equity often explains success better than financial ratios in many industries. Even without numbers, you can assess capital allocation by observing behavior. Does the company reinvest wisely in growth initiatives? Does it avoid unnecessary debt or speculative ventures? Are resources allocated to areas that generate real value, or are they spent on appearances? Judging decisions and priorities without diving into spreadsheets strengthens intuition and understanding. Supply chain and operational efficiency are also observable. How does the company manage logistics, relationships with vendors, and production capacity? Do they maintain flexibility or struggle under pressure? Operational inefficiencies often appear in qualitative ways before they affect numbers. Regulatory and legal compliance cannot be ignored. Companies with ongoing legal troubles, poor governance, or regulatory scrutiny are inherently riskier. Observing management transparency, legal disclosures, and public reporting gives insights into governance health without deep accounting knowledge. A powerful tool in qualitative evaluation is storytelling. Every company has a narrative, what it aims to achieve, how it creates value, and how it deals with challenges. Narratives that align with reality, demonstrate consistency, and show adaptability are strong indicators of potential. Narratives built on hype, exaggeration, or unrealistic promises often lead to disappointment. The minority combines these observations with selective use of numbers. Qualitative assessment provides context, intuition, and understanding. Numbers confirm, refine, and validate insights, rather than being the only source of truth. Beginners who focus exclusively on numbers often miss context, trends, and underlying structural strengths. Start practicing by studying companies you interact with as a consumer. Notice which ones provide consistent value, which maintain quality, and which seem to endure challenges gracefully. Observe without judgment, taking note of patterns and behaviors. This builds the mental framework necessary to evaluate businesses naturally and independently. Finally, remember that evaluating a company without numbers is not about guessing. It is about disciplined observation, pattern recognition, and understanding human behavior of management, employees, customers, and competitors. It strengthens judgment and reduces dependence on fleeting statistics, tips, or market noise. Thinking like the minority requires seeing the business as a living entity, not a spreadsheet. It is about recognizing durability, adaptability, and alignment with long-term value creation. Numbers provide precision, but qualitative insight provides clarity, intuition, and survival advantage. By mastering this approach, you build a mindset that can identify resilient businesses before they are recognized by the majority, giving you a true edge in markets.